All right, today we're going to crack open one of the oldest, most fundamental tools in any investor's toolkit, the price-to-book ratio. We're going to break down what it is, exactly how it works, and maybe most importantly, how you can avoid some of its most common and costly traps.
You know the feeling, right? It's the question every single one of us asks when we're looking at a stock. Is this thing a hidden gem, a total bargain, or is it just an overhyped bubble waiting to pop? You can see the price, but what are you actually getting for your money? Well, the price-to-book ratio is one of the first clues we can use to start answering that question.
Okay, so to really get to PB ratio, you first have to understand this fundamental conflict, this kind of battle between what a company's stock price is and what the company is actually worth on paper.
So on one hand, you've got the market value, or the stock price. You can think of this as the popular vote. It's driven by hype, by news, by emotion, and by everyone's hopes for the future. But on the other hand, you have the book value. This is the, let's say, less glamorous, strictly by-the-numbers accounting value. The PB ratio simply measures the gap between the market's dream and the company's on-paper reality.
Here's an easy way to think about it. Imagine you're buying a used car. The book value is like the official Blue Book value of all its parts. The engine, the tires, the chassis. It's the technical, on-paper worth. But the price? That's what the seller is actually asking for it. Now, is it a classic car that's worth way more than its parts? Or is it a clunker that's about to fall apart? That difference? That's what we're talking about.
So let's pop the hood on this on-paper value. What exactly goes into a company's book value? Where does that number even come from?
You can think of book value as the going out of business number. Seriously. If a company decided to shut down tomorrow, sold off everything it owns, all the factories, the equipment, the inventory, and then used that cash to pay off every single one of its debts, the money left over, that is the book value. It's the raw, tangible value that technically belongs to the shareholders.
Okay, enough with the theory. Theory is great, but let's make this real. We're going to get our hands dirty and calculate the PB ratio for a made-up company we'll call Widgets Corp, just to see exactly how the sausage is made. All right, here are the vital stats for Widgets Corp. We've got the current stock price, $50. We know what it owns, its assets, and what it owes, its liabilities. And we know how many slices the company pie is cut into, the number of shares. Now, let's put it all together.
Don't worry, the math is actually super simple. It's just a three-step process. First, we need to find the company's total book value.
So, step 1. We take the total assets, subtract the total liabilities, and boom! That gives us a total book value of $250 million. Easy enough.
Next up, we need to know what that's worth on a per-share basis. So, we take that $250 million book value and divide it by the 25 million shares out there. That gives us a book value per share, or BVPS, of exactly $10.
And now for the final step. We take the current stock price, which is $50, and divide it by that $10 book value per share we just calculated.
Which gives us our answer. The price-to-book ratio for Widgets Corp is 5.0.
Okay, so 5. We have a number, but a number by itself is pretty much meaningless, right? What does a PB of 5.0 actually tell us as investors? What's the story behind it? So here's the classic textbook interpretation. A PB ratio under 1 is what value investors traditionally look for. It could mean the market is pricing the company for less than its physical parts are worth, a potential bargain. A ratio over 1 suggests the market sees something more. It's betting on future growth, on innovation, on something beyond just the assets. So for our company, Widgets Corp, a ratio of 5.0 means that investors are willing to pay $5 for every single dollar of its on-paper accounting worth. Why on earth would they pay such a premium? Well, they're betting on all the things that don't show up on the balance sheet. The power of its brand, the genius of its leadership, and its potential to generate huge profits down the road. And this brings us to the most tempting and, honestly, the most dangerous conclusion a new investor can jump to. If a low PB ratio means a stock is cheap, then shouldn't you just go out and buy every single stock you can find with a PB below 1?
And the answer to that is a huge, resounding no. Absolutely not. Because a financial ratio in a vacuum is just a number. The real insight, the actual wisdom, comes from understanding the context that surrounds that number.
This is so important to remember. The PB ratio has major blind spots. It was designed for an industrial economy. It's great at valuing physical things like factories, but it completely whiffs on modern value drivers like brand loyalty, patents, or proprietary software. And sometimes a really low ratio isn't a bargain at all. It's a giant red flag that the company is in serious trouble.
And this really brings us to the golden rule. Context is king. You have to compare apples to apples. A software company with almost no physical assets might have a P/B of 10 and still be undervalued. But a big old manufacturing company with a P/B of 2 could be wildly overpriced. Using this ratio to compare companies in totally different industries is a classic rookie mistake, and you've got to avoid it.
So, if you remember one thing, let it be this. The price-to-book ratio is a fantastic starting point. It's a great tool for understanding how the market prices a company's assets, but it is never the final word. Finding the true value, well, that requires you to look deeper, to ask smarter questions, and to always consider the context.